Cool. Great. Thank you so much for being on here with us today. It's really a pleasure to, talk with somebody like you with your, past history and accomplishments and with Raise Capital and with how we're helping the startup ecosystem in Boston. Um, and yeah, I mean, just this podcast style interview is basically going to be about what your advice is for the Boston startup ecosystem, but also it's geared toward founders. Yeah, let's raise some trouble, Steve, with the puns now.
I love it. Yeah. I mean, I've been working with founders for many years, and certainly I'm in the Boston area, so certainly want to give back to the Boston community. But I help founders really all over the world. I've worked with companies out of London, Australia, Ireland, Colombia, and other countries as well. And so a lot of lessons around both running a company, raising capital, working with VCs and angels. I want to make sure that this is kind of an open forum for questions.
Yep.
And, my personal goal is to give back to entrepreneurs, because when I was starting my company, I ended up bootstrapping my business. I went and talked to VCs, and they really wouldn't give me the time of day. And it's because I really didn't understand the language of venture capital, what was important. At the time, accelerators really didn't exist, or they weren't particularly prevalent. I think Techstars and YC were going through their years 1, 2, and 3. So it was pretty early in that kind of history. And certainly over the last 5, 10 years, startups, entrepreneurship, accelerators, there's a lot more access to these programs, but there's still a lot of disinformation, a lot of confusion, especially for first-time founders and entrepreneurs in terms of how to communicate, how to make progress, how to run their companies, what they should pay attention to, and kind of what they should also ignore.
Oh yeah, absolutely. And it's really important about your experience. Obviously in Techstars, being the former managing director and now the founder and chief troublemaker, as you call it, at Race Capital. And as you mentioned, when you were just starting out, it was difficult for you to maintain relationships with venture capitalists, angels, because you really didn't understand the language, and it was your first time, right? And what Steve, Jason, and I are also working on is Techstar Startup Weekend in September, and all the audience there are going to be first-time founders, and most of the people on this call are pretty new in terms of meeting VCs, building and maintaining relationships with them. So I guess my question would be towards how would you recommend first-time founders and early stage founders to maintain that relationship with VCs or even
Yeah,
angels
absolutely.
for that matter?
Yeah, I think one of the things people should really think about is that, when you're talking to whether it's angels or VCs or other folks, it's really about building longer term relationships and not being overly transactional. And so one of the key pieces of advice I give to founders is that investors invest in lines, not dots. And so when you can tell a story and allow someone to track you over time, they can really see the progress of what you're doing and how you're getting there. So one of the key differences, one of the key things I'm doing right now, I'm running my own accelerator program, and I'm working with a lot of founders. And unlike some of the other programs, I'm really leaned into that relationship. And so rather than doing kind of applications open, applications closed, I'm really trying to allow founders to build a relationship. And that's actually what we've seen in a number of these programs, that it's, many founders apply and then they either get in or they don't get in. And sometimes they get disheartened and they're like, oh, I didn't get in, I'm not good enough. And it's really because, that's the first touch point that you may have had with that particular investor, accelerator, or whatever. And so rather than thinking of it as a single point in time, it's really about a longer term relationship and trying to get value from each conversation. And so oftentimes I see founders having a conversation, again, whether it's with an angel or a VC, and they're looking for a check in that first conversation. And really, investors invest in 3 stages. Stage 1 is an emotional investment. They have to care about you as a founder. They have to care about your problem. They have to care about what you're doing. Oh, did I cut out? Can you hear me? Okay. Yeah, they have to care about you as a person. They have to care about the problem that you're solving. So sometimes I'll have founders reach out to me and they're like, "Hey, Greg, I'm doing a crypto mining startup in Antarctica, and I want you to invest." And I'm like, "Dude, like, if you do a little bit of homework on me, like, I don't do a lot of stuff in that particular domain. I don't have a lot of interest. I don't tweet about it. I don't write about it, and so I don't have a lot of emotional connection to that. And so you're going to have trouble getting to the second step. The second step is, once you have someone interested in either you as the founder or your general problem space, the thing that you're doing, the second investment is an intellectual investment. It means that investor wants to challenge you intellectually. They're going to ask you questions about your business. Hey, have you thought about this? What are you doing with the business? How are you going to market? How are you thinking about growth? Who else is on your team? How are you thinking about marketing this? What's your moat? They're challenging you intellectually to see how you think about this problem. Once founders and investors kind of go through that intellectual challenge, that they've invested in you emotionally, they've invested in you intellectually, then investors will think about the financial implications of investing in you. And so that's really when investors will start asking questions around, okay, what's your CAC? What's your LTV? What's your financial model? How do you scale? Those three areas of investment: intellectual, um, emotional, and financial. All three are important. Sometimes people kind of dive into the third, financial investment, without checking off the boxes of the first two. The other piece of advice I give to founders is that raising capital, again, if you're interested in getting money from VCs, it is sales. And so all the same characteristics and mechanics that work in sales work in raising capital. In fact, when you are raising capital, you are selling a product. Your product is equity in your company. And similar to sales, it has all the same mechanics. You have to really think through, okay, what is the top of the funnel? How many top of the funnel conversations do I have to get to a first meeting? From the first meeting, how many conversations do I have to build the emotional connection, to build the intellectual connection, to get to a second meeting or a third meeting? And then ultimately at the bottom of the funnel is the deal, right? The term sheet. And so when founders don't think about it like a sales process, they'll kind of have these occasional onesie twosies meetings and they won't go very far. And you really do have to think of it as a sales process, to think like, what is my value proposition? What is the uniqueness of my thing? What is the optionality that the investor has? How do I put pressure on a deal, right? Like, if you've ever done any type of sales, deals don't close unless there is budget, authority, need, and timing. So you need to be talking to someone who has budget, potential money to invest in your company. You need to talk to someone who has authority, the ability to actually make a decision. Sometimes people will spend a lot of time with lower level people, or people who don't have authority or decision-making ability within a VC. They have to have a need. And so they have to be like investing in your sector. They have to have, dry powder or capital to invest in companies. They have to write check sizes that are commensurate with what you're looking for. And the last is timing. There has to be a timing pressure where they feel, and oftentimes in investing it's called FOMO, but they have to feel a little bit of pressure that they either have to decide to be in your deal or out of your deal. Same thing with any type of sales. If you're doing B2B sales or customer sales or any other kind of sales, when you have budget, authority, need, and timing, that's when deals get done. And if you are missing even one of those things, it's typical that the deal will drag.
That's amazing. So, a lot of points that you made, and I will also be mindful of the chat here. Uh, Melis has two great questions. I'd be happy to bring Melis on as a co-host here. Melis, if you want to, because this is more of a conversational kind of podcast. So, if you want to ask your questions through audio, please feel free. Or
Oh my God, I'm driving, but I'm happy to do so.
oh,
Hi, Melise. Nice to hear from you.
Hi,
Go ahead. I
Greg.
can read your question, but I'd rather hear it from you.
Absolutely. So I said one of the things that I myself as a founder have been seeing, or two questions that I always find an investor ask, specifically on the VC side, Greg, and I'm sure, I'm, I'm pretty sure I got one of those questions from you as well the last time you and I had met, is how do you position yourself when you're talking about PLG? That's one of my questions, which is kind of when you are asking, when someone's asking, that's a very specific question for SaaS, for I would
Yeah,
say.
Melissa, you're cutting out a little bit.
Um,
You're cutting out a little bit. I'm just going to read your question. It's really product-led growth. When an investor asks about product-led growth for a SaaS
your
tool,
first
can you
your
give?
first meeting, they're more interested in hearing about you and if they like you as a founder, and then they want to understand how big the opportunity is. How can you best position yourself? Because there's a chicken or the egg situation there in terms of go to market, which is here's who I'm selling to today, and here's how big the opportunity can be for our startup, our product tomorrow. Are there any insights that you can share to for founders who are here to listen to, kind of how do we best position ourselves? How do we tackle that question for an investor? And we don't always have to have the answers, right? I think that every
Sure.
pitch has a learning session too.
Yeah, absolutely. I think you're spot on there. You definitely want to be learning something from every conversation. So, founders definitely don't be shy to ask investors questions so that you're getting value flowing in both directions. In terms of the two areas that you talked about, one is articulating your TAM, or your total addressable market. Key thing for investors, and founders should understand this, investors are typically looking for each of their investments in a single company to be able to return the majority of the fund back to them if that company is successful. And again, this is probably a longer conversation than this podcast, but the financial model for many VCs is oriented around that. That means that it should be possible for any individual investment to usually return, up to 100x the investment. And so if you're asking for, say, 100 grand, it should be somewhat possible for that company to return 100 times that. And so from a total addressable market perspective, you want to make sure that it is believable that your company could grow into a space that is large enough to be able to return the funds at a multiple of what you're asking for. And so one mistake I've definitely seen founders make is that they don't really do the math on this early on when they're asking for a particular investment, and they either ask for too much or too little. And so if you are asking for too much money up front, it may be difficult to run the projection of how your company could grow large enough to return as much money commiserate to the percentage that you're asking for. On the flip side, I've also seen founders, they ask for too little from a fund that has too much capital to deploy. It's a much larger fund. And so, two examples. If you're asking for, a $5 million check from a $20 million fund, there's going to be a mismatch. You cannot get that much capital from a fund that small because they have to return a much larger number. On the flip side, if you're asking for a 200K check from a $1 billion fund, it may be difficult for that math to work as well. And so as you think about your TAM, make sure that you are understanding who you're talking to and understanding the typical check sizes that they write, and that you can ultimately grow into something that is believable. The TAM,
Greg,
in my opinion, is
I have one quick question on that topic. I'm so sorry, just to kind of
yeah.
echo what you said. So I think, and I speak to a ton of my founder friends on a daily basis, and we try to support each other. One of the things that I hear quite frequently is regarding this, I think because it also connects to financial projections. Everyone is told you need a 5-year, but investors at this early stage, especially if you're like pre-seed or seed, want to see kind of like a 2-year, and they want to see what you're going to do with what you're raising. So they want to see a direct correlation with I'm throwing it out there like 3 million, 4 million. and here's my 2-year projection. Here's what I'm going to be doing with the money. Here's how it's going to grow my sales. Here's how it's going to, affect my bottom line, my revenue. Here's what I'm doing with R&D. And you are right. Everyone is having issues with either too little or too small. Founders are either positioning themselves because they're scared because of what's happening with the market or what's been happening with the market, which is less money being deployed. So they're asking for less just so that they can get by. They're asking for too much because and in return sounding a little delusional when speaking to the VC. I've heard less in the sense of you're asking for 3 million, or you're asking for $1 million from a VC that has like a $10 million fund, but more so I've heard you're asking for an amount, and the VC is finding it either too little or too much, not for their fund, but just generally for your business. I'd love to know how you think founders should be, first of all, doing math, doing the bottom up approach, doing the math, doing the projections properly. And if there's any insights you can share, that would be great.
Yeah, I mean, this is a universal problem, and I will say that there is no silver bullet. I wish there were. The thing that is most helpful is to build a financial model. And when I see really thoughtful financial models, this can be a really invaluable tool for having the discussion of why you need a particular amount of capital and what you can do with that particular capital. Ultimately, a lot of venture capitalists view startups as interchangeable ATM machines. And by that, I mean, they view the startup as like, I can put $1 in and my expectations are that I get a certain amount of money back out. And sometimes that financial model works in certain numbers. Sometimes that financial model breaks at other numbers. And so as a founder is building a model, like if you're like, okay, I know I can acquire this many customers. I know I can monetize it for this. I know I can grow at this rate. And then run the model and be like, okay, if I intake an extra $2 million, do I grow faster? Do I grow slower? Like, am I being overly optimistic or is this realistic? And when you have a good model and you can run it up and down, it can give you a discussion point to talk to investors about whether you can intake more capital. I know a specific story where a founder was talking to an investor. They were interested in the company. They were going back and forth, and they were trying to figure out kind of allocation and dilution. And the founder was able to pull up the model and say, look, I can intake more money. This is what the projections will look like. And because that founder was already past the emotional investment, they were interested in the founder, they were interested in the company, they were doing the intellectual exercise with the founder. They're able to have a really thoughtful discussion around the financials because they had a model, they could play with it. They were like, okay, well, if I put more money in, what actually happens? And they're like, okay, well, when you put more money in, my CAC starts going up because as I start spending more money, my utilization of my money gets lower. I hire more people, which means I can activate more cities, more geographies, more metros. But then this other metric goes down, and they can kind of play with the numbers and see what the right number is. Founders, this is helpful for you so that you're not, you'll always be guessing, but you will be guessing less when you have a little bit of a model. There's a company I angel invested in that had a beautiful model, and it actually bubbled up from yearly to monthly to quarterly. And so they could really play with their assumptions. Okay, if my CAC changes year over year, what happens in the downstream years? As my CAC changes and my customer acquisition costs changes, what happens to my lifetime value? Okay, if my lifetime value drops, what happens to this other? And so they built this model up slowly. And so they started with a clean spreadsheet and they were like, okay, what assumptions do I have today about my business? And then how do I validate those assumptions month over month? And so it is a little bit of a guess from a founder perspective, but it becomes a more educated guess month over month as you run your business. And then it becomes a really good tool for discussion because it's not made up. It's not like completely, hey, I pulled these numbers out of the air. When I was running my business, I kind of did the same thing. Like initially, I had a spreadsheet that was my financial projections for 2 months into the future, right? Because I didn't have a crystal ball. It was difficult to tell what the business would do. But month over month, it would be like I would start to build in actuals that would become assumptions. Like I knew my churn rate, I knew my customer acquisition rate. I started to know my win rate, which meant that I could have a much more intellectual discussion with anyone. Again, I wasn't raising venture at that point, but it was more operationally internally. Do we have the confidence to hire 3 people? Will we have enough business to support those 3 people, or will we be light? We have this big deal in the pipeline. What's the probability that we'll win that? Looking forward into Q3 and Q4, are we going to be light or are we going to be busy? Should we hire ahead or shouldn't we? And when you have a good model, it really de-risks the business.
Thank you so much. I think de-risking is one thing that I've seen works when you're talking to VCs or just general investors, because you being able to show thought about the oh my gosh, what if um, makes them feel more comfortable with you and confident with you as a founder, and knowing that you're not living in the clouds thinking everything is going to go just right.
Yeah, I've been researching founders and what leads to increased probability of success. And so I've been building just for myself what I call a predictive index, and asking a bunch of questions of founders who have been both successful and people who are right in the throes of building a business. And one of the interesting questions is that running a little bit nervous, a little bit cautionary, a little bit thoughtful is actually helpful to founders. Like it feels like that anxiety can serve founders in a good way. And so you have to kind of monitor that. You want to be ambitious and excited and pushing and changing the world, but you have to have a little bit of that, like, okay, like what if things go wrong? How do I protect the business? Like what's plan B? And when you have that ambition mixed with that kind of internal pessimism and how do I protect the business, like that actually is super helpful on both fronts.
Do you think that goes hand in hand with PLG too, Greg? So at the end of the day, I'm so sorry, Vivek. I feel like I'm taking all your questions.
No, it's fine. It's a podcast where we're chatting.
Yeah.
Amazing. I just want to know, PLG is something that I spend a lot of time thinking about, and I think that it's you just made a great point. We have to de-risk the business. De-risking the business also means that the business needs to exist without you being there. And God forbid if something happened to you. The VC, of course, or the investor is investing because they like you as a founder or they like you guys as a founding team. But they're investing. The reason they're making the decision later on when you're like A or B and raising much larger funds is because it's a sustainable business model. It's something that's going to continue to scale. How would you what do you like hearing? What are the aha moments you get from PLG when you ask PLG questions? What do you like seeing in terms of metrics and that make you feel like, okay, this product is definitely being led by product-led growth. They have something here.
So I'm going to say something controversial. I don't believe in product-led growth. Now,
oh no!
don't get me wrong. Let me explain what I mean. And so, first of all, I have a deep background in product. I believe it is extremely important that you build a fantastically great product. But when I look at companies that are traditionally called product-led growth companies, and a lot of people point to companies like Slack or Dropbox or other things in that vein, and you go look at how these companies are actually run, they have huge sales teams. And so, one, I do think it's incredibly important to have a fantastic product, but I also think it's important for founders to really think about how they control the growth of their business. And if you look at any company that claims it's product-led growth, typically what I actually see, if you go look on their LinkedIn, as they scale, they start to realize that product-led growth starts to tap out at a certain number. And when it starts to tap out, you start to think through the mechanics of how you actually orchestrate the further growth of your business. Now, there are absolutely some exceptions to this, like I know there are a number of companies that don't do a lot of advertising, and they grow a lot through word of mouth. But even in those companies, there are lots of mechanics that they've actually thought through from both a marketing and a channel perspective that allow them to control their destiny. And so for companies that are building great products, again, I'm not saying don't build great products, absolutely build a great product, think through what the product experience is, what the referral rate is, but it's important that customers also think through customer acquisition costs. And so I went to the Inc. 5000 conference, which is a conference for fastest growing companies. It's a great conference. We won the Inc. 5000 when I was a CEO, I think 4 times in a row. And one of the speakers was Mark Hershevek, one of the Shark Tank guys. And he came up there and he said, if your growth strategy is customer referrals and customers talking about you, you're in trouble. And I was like so shocked because we had a lot of customer referrals. A lot of customers were talking about us, and that was how we had grown. And he said, look, customers talking about you is great, but what happens if for some reason customers decide to stop talking less about you? Does that mean your company should fail? If you don't have a marketing strategy, if you don't have a way to reach your audience, if you don't control your own channel, if you don't have customer acquisition costs that you can turn the dial up or down, you could be in trouble. Maybe not today, but maybe someday in the future. And so when you can control your funnel, your customer acquisition costs, your marketing channel, you're in much more control. And so as soon as I heard that, I was like, oh man, he's right. Like I don't control, like customers were really good. They loved us. They talked about us. They would always refer us, but we were like, what happens if they don't? Or what happens if in a particular quarter, it's just slower and they're busy and they don't make referrals? Like, how do we control that? And so we started to think about sales channel. We started to think about outreach. We started to think about inbound. We started to think about podcasts and marketing channels and things like that. And that allowed us to have our own customer acquisition costs, our own predictability, so we could determine the future of our growth in our company, 3 months, 6 months, 12 months into the future. And so I do think it's important to have great products, but don't overly be dependent on product-led growth and the growth of the product, your customers, to further your growth. You want to make sure you're controlling more of that, or at least some of that, for your company as well.
On that note, what's the right time to move away from founder-led sales, which I guess every investor loves hearing anyway, because you need to be able to sell what you've built. When should you move from founder-led sales to hiring your first sales rep? And then the difference between a sales rep and a customer success rep.
Yeah, quickly, I would say that founder-led sales is really good in the beginning of your company when you're learning what is your ideal customer profile, like who is the ideal customer, how much can we learn from that ideal customer. At a certain point, you start to find repeatability in who your ideal customer is and how people are buying. At that point, it's, you as a CEO should start to feel like, man, there is too many deals and not enough time, and your time is better spent thinking through the longer term opportunities of the business growth. And so it's different for every company. The typical guidance I give to a lot of founders is that there's a little bit of a dead zone. And again, it's very dependent on the company, but if a company is selling larger deals, they're selling deals usually above $25,000. That's when it starts to make financial sense to start to bring on salespeople. Below that, the math is sometimes a little bit tricky, because if you're selling a $5,000 or $10,000 deal, it's difficult to get the financial incentives to be able to bring on a salesperson and bring on the right commission structure and kind of figure out the mechanics of that. And so usually it's somewhere in that sweet spot where founder-led growth is leading to deals that are starting to feel repeatable. Some of the deals are 10, 15K starting to be 20K. As you're starting to get that and you're starting to get repeatability, it's really, typically the time when founders are like, okay, well, let me start to bring on someone who's usually a little more junior in the sales side, so you can train them up. They can kind of be your wing person to see how you sell. And if you're starting to feel that repeatability, it frees up the CEO to kind of go do other things. The account manager versus salesperson, again, probably a longer discussion. We'll kind of focus this a little bit more. I know Vivek had a number of other questions, so I'll turn it back over to him.
Yeah, I mean, those were amazing questions. And even in the chat, Jason is talking about how investors usually look at the person, the problem exists today, but it might not exist, or it might exist, 10 years from now, but how you look at the founder and his personality and his achievements is really uh, another thing that investors look at, which is absolutely true. And, Park also shared a few links about, researches founders can look through. It's pretty useful. And talking about, because you invest, or you have experience investing in, early stage startups, who are pretty early to the market. One of the questions that I had was, what are a few challenges that they face that you think as an investor is the most important challenge? And how, that what have you observed that early stage startups usually face in terms of challenges in their stage?
Yeah, I mean, there's so many. So first of all, to all the founders, I applaud you guys because it's such a freaking difficult journey, and if your friends, your family, people who are not in the entrepreneurial space just do not understand, because you are wearing all the hats, right? You are hiring, you're thinking about product, you're thinking about engineering, you're thinking about product market fit, you're thinking about investors. Like, there are so many challenges. There are three kind of core things that in my research kind of kill companies and founders should be more wary of in terms of macro level challenges. The first is culture. And it may be strange to say that, because lots of times early stage founders aren't thinking as much about that. But honestly, I've seen a lot of companies blow up because of mismatches between founders, co-founders. And ultimately, that often derives from what I call the early culture of the company. And so articulating and ideally even writing it down, like, what is the mission, vision, and values of the company? Why does your company need to exist? And who are going to be the right types of people who believe in that mission, vision, and those values that should be part of the company? Oftentimes, early teams are kind of organically formed, sometimes in college or school, sometimes within subgroups of a work environment, sometimes through other mutual connections and hackathons. And so as a founder, thinking through where you're going and why you're going there is pretty important. The second is cash flow. And so key reason companies go out of business is they run out of money. And there's two reasons to run out of money. One is the financials of the business don't quite make sense, or you don't have enough margin, or you don't have enough mechanics in the business to cash flow. And then very related to that is, because some of the financials are challenging in the business from a cash flow perspective, it makes it sometimes difficult to raise venture capital. And so both of those are kind of intertwined, but effectively it's running out of money in some way, shape, or form. Early companies that can kind of figure out some of the cash flow mechanics improve the probability of raising capital, because it's much easier to raise capital if you're like, hey, we have a couple $100,000 in revenue. Like, maybe it's not super repeatable, but we have some insulation from talking to VCs and them saying no. It increases your optionality as a founder. And so thinking through, okay, how do I use the entire capital toolkit? And so VCs are just one tool in the capital toolkit. And so founders shouldn't think like, oh, well, if VCs tell me no, then I'm out of business. It should be like, okay, well, how can I fund it through customer? And so sometimes customers will be willing to fund your business because you're solving a problem that's so valuable for the company. And I have seen companies say, okay, well, I'm willing to pay 50% of the yearly whatever SaaS thing because the problem it solves is so valuable. I've seen debt, I've seen equity, I've seen banks, I've seen credit cards, I've seen savings, I've seen side hustles. As you think about the optionality for your business, you improve the probability that your company will not run out of money. And therefore, you live to fight another day and find the ideal product market fit and get the right cash flow into your business to further accelerate your growth.
That's amazing. And Steve and I and Jason are also part of Boston New Technology, and every time we go on a call, it's fun, And I've seen a lot of startups, met a lot of founders that really focus on culture, and this is what I really, really admire about Techstars is they focus so much on culture. And I was talking to a friend of mine, and I believe you met her at the Visible Hands event too. Amruta, she worked at Techstars New York, and she was telling me the company culture is so, so, so important that in sometimes that's the most important thing in terms of how it drives the company forward, and also how investors look at the startup too. You could have all the other things figured out, but if you have a little bit of toxic work culture or whatever, it's not no investor is going to look at that and say green sign. Um, but yeah, and with oh yeah, Visible Hands is amazing. I'm a huge fan of Visible Hands.
Yeah, they had a great event the other day. A number of startups presented, and I'm actually investing in a couple from the class. We'll announce that later this year. But I think for early stage founders, thinking through what you're doing and why you're doing it is very important, right? Because it fuels your battery, right? Like the founder journey, as I said, is incredibly difficult. And if you don't have something that is deeply meaningful to you and your team, you're just going to run out of energy. And I've seen that a lot. People solving interesting problems that can make a little bit of money or in some cases a lot of money, but they don't have the fire in their belly. They don't have the energy and the passion to kind of really go for it. Like a startup can take a lot out of you, both in terms of time, energy, resources, and personal finances, right? Like this stuff is really difficult. And so if you're not aiming for something that is truly impactful and something that you really believe at the core of the company, people are going to phone it in. And this is, I've seen numerous times when, again, usually the CEO is wired because they're all in. But other early team members, for them, it may be their first or second job out of college. They may be paying off student debts. They may be having other things going on in their life. And so getting that this is the thing I'm doing. That's the fire that can really take a company from good to great. And so it's difficult. It's really difficult in the early years.
Exactly. And Melissa, founders need to treat themselves like the Olympic athletes. Oh yeah, take care from
Yeah,
that.
mental health is a really big deal for founders. And Melissa, I'm glad you mentioned that you have a founder group that you talk to. That's one of the key things for founders to talk to other founders, right? Like
Oh my
nobody.
God, Greg, it's lonely out there.
It is really like that's one of the things I say. Like being a founder CEO is can be one of the loneliest jobs if you don't have a network, if you don't talk to people, if you kind of bottle it up. This is really hard, and everyone thinks that they're the only one. And so if you're like, oh, I'm the only one, I keep hearing no's from investors, I keep hearing no's from customers, I keep missing X, Y, Z. And not just in the company, sometimes it's the personal life as well. Like my partner doesn't understand, I'm working crazy hours, I can't see my kids as much as I want to. Like this stuff is really, really difficult. And so having a peer group and a network or other founders that you can talk to is hugely valuable for your mental health and your ability to get there. And it's okay not to be okay, right? Like everyone has bad days, bad weeks, and bad quarters. I remember when I was running my company, I had the worst imposter syndrome. I was getting an award for some kind of Boston Business Award or whatever. So I'm sitting at this fancy dinner getting this award, and everyone's clapping and cheering. And I'm sitting there mentally in my head, I'm going like, I don't know how I'm going to make payroll this month. I'm a complete fraud. Everyone around here doesn't know it. And it's like completely isolating and lonely. And again, like, if you don't have people to talk to, it can be really toxic. And so just make sure you're taking care of yourself. You're taking care of your body, mind, and your whole person, because this stuff is really hard.
Yeah, and since you've gone through this yourself and you invested in so many startups, what's your I wanted to like see how would you guide your startup portfolio startup founders if they're going through something like that? Um, like how do you provide guidance? I mean, apart from the investment aspect of it at Raise Capital, how do you approach like providing guidance and support to startups? Like what are some key areas that you focus on in supporting them?
Yeah, I think it's really about being, make sure that some of the people on your cap table, it doesn't have to be all the people, but you allow yourself to be vulnerable. A lot of people, especially CEOs, think that they have to project this invincible, this I can do anything and everything persona. But oftentimes, when founders can allow themselves to be vulnerable with, and again, it doesn't have to be with all your investors, all your advisors, but have a set of trusted people who you can say what's really going on, because those people are there to help you, right? Like I've had a number of companies go out of business or be acqui-hired. I've had a number of companies have to go through pivots or layoffs. I've certainly done rounds of layoffs myself. It is absolutely the worst thing. And if you don't have people you can talk to about the stuff that's really going on, it's just, you're going to have even more weight on your own shoulders. When you feel like you have a team around you that is helping you think through these problems, helping you think through the decisions that you have to make, it lightens the load. It makes it easier for you to really build the incredible company that you want to build.
Yeah, that's amazing. And one of the things that I've observed that first time founders do is, and I would love to get people to talk about this as well, is uh, what are some green flags or red flags when it comes to VCs and investors? Because I'm sure you've talked to dozens and dozens of VCs and investors when you were a founder, and that when you were MD at Techstars and now at Raise Capital. Um, what are a few things that's a really good thing to have for a VC? Is it like something like a initial impression, or what's your recommendation for that?
Yeah, I mean, uh, there's always going to be the initial impression and how you project yourself. Again, I would stress to founders that build longer term relationships, and don't be so focused on the point in time. Think about the arc of that relationship. The biggest green flag, the thing that founders can do and many founders don't do, is following up. And so oftentimes I'll get on a daily, weekly basis, I get a lot of people inbound sending me LinkedIn, sending me DMs over Twitter, sending me messages via my website, and that's fine. And again, I'll go through all of them. I'll try to respond to many of them, but oftentimes founders will not take the time 3 weeks or a month down the road to send me a high level update, especially if I expressed any amount of interest. And so that is the thing that is a green flag. It shows me progress and updates. And again, I have one recent example of this. I had what for me was kind of a one-off conversation, meaning that the founder sent me a deck. I took a look at the deck. I said, hey, here's what I like about this. Here's what I don't. And for me, I kind of forgot about it. And the founder followed up with me like 2 months later, and he said, hey, Greg, thank you so much for that conversation. You gave me these 4 pieces of advice. I took action on 3 of them. Here is the outcome. Thank you so much. Here's the updated financials from since the last time we talked. Now, that was an incredibly green flag for me, right? Because A, they heard my feedback, they took action on my feedback, and they're showing me the results of the feedback. Again, investors invest in lines, not dots. That is going to give me 2 really good points to start drawing a line from. It's like, oh, I remember that conversation a couple months back. Oh, they listened to my feedback. They're super coachable. They took action on the feedback. The feedback was actually helpful for them. And this is the new data point in time of where they are from the revenue, customers, attraction, and momentum. Now I'm starting to actually understand their traction. I'm starting to build that emotional investment. And now I'm intellectually connected, right? Like I'm like, oh, cool. Like he's taking action on something that I told him. Like maybe I want to invest more of my time to see where he is and give him an additional boost or additional push or additional question. And so follow up. The easiest thing, and I see this a lot, founders will say they're going to do something, but it's rare for the investor to see that the founder actually did the thing that they said they were going to do and to close the loop. Huge green flag. Definitely something you can do.
That's awesome advice. And I know we're coming short of time here, but one of the last questions I had was, as you know, the startup ecosystem is so dynamic and it changes every single day, and it's hard to stay updated with the latest trends and developments in this ecosystem. So how do you stay? I mean, I'm very curious as to ask you, how do you stay up to date with these trends, and how do you integrate that with your work with your startups?
Yeah, I mean, there's always a lot of stuff to read, and so I actually try not to like overly dive into the hacker news and the tech crunch and stuff like that. There's just too much. Um, I'll try to focus on the companies and what they're actually doing and working on. And then I keep my radar up for things that are relevant or topical. And so, generally it's very easy to be distracted by the echo chamber of the startup ecosystem. And for most startups, it's really like stay focused on what you're actually trying to execute for the month of the quarter. And so if you are in the early stage and you're trying to identify your ideal customer profile, like cool, dive in to how to do that. And there's a bunch of resources and things around that. If you're diving into sales, cool, dive into sales. But don't drink from the fire hose of like all the different things that are out there, because it's actually oftentimes a distraction. The best practices do tend to bubble up, meaning that you'll hear the 0 to 1s or the lean startup methodology or other things like that. Those will come through if you're searching for things in a particular domain, but you don't really have to be in the whole ecosystem. Focus on the traction for your business, right? There's a lot of noise out there, and frankly a lot of it can be ignored. If you're in a particularly technical domain, keeping up with the technology in your specific technical domain, like I'm spending a lot of time in AI, and so there's things that I follow or newsletters that I get specific to AI that I'm going to read and keep up on because I don't want to miss a particular trend. But I don't try to do that across the entire field. There's just too much noise.
That's true. Yeah. Um, I mean, I had one last question. Before I do that, I want to turn this over to the people that are listening in. If you guys have any questions, feel free to put them in the chat, or if you want to ask Greg, on the platform, I'd be happy to invite you on. So I'm just gonna give a couple of seconds because I see a lot of my friends who are founders that are on this call as well. So feel free to ask any questions, guys.
Yeah, and while you guys are typing, a couple resources just for folks and a little background on myself, because I don't think I covered this at the beginning. I started a company myself. It was in the mobile technology space. It was called Raiz Labs prior to starting to angel invest. And I sold that company late 2017, started angel investing, working with early stage founders. I ran Techstars in Boston and transitioned to running my own micro accelerator that I am in the process of building out. And that's a little more of a focus on AI. And the reason it has a little more of a focus is that my research led me to identify that one of the leading factors for startup success is timing. And so certain companies can only exist at certain times. And kind of, if you look at, very, very successful companies, often they launched or grew at a particular time in history where it was possible for that company to exist. And so Amazon could only exist once the internet started to be a thing. And so Jeff Bezos jumped on the Amazon opportunity because he saw how quickly the internet was growing. Uber could only exist when mobile phones started to have smart apps and smartphones. And so it couldn't have existed pre-iPhone. It had to exist a little bit after the iPhone moment. And so similarly, I'm spending a little more time in the AI space because there's certain companies that can exist because of the revolution we're seeing in AI that couldn't exist otherwise. I try to be helpful to entrepreneurs. So again, if you have questions for me, definitely you can hit me on Twitter. I also have a YouTube channel where I try to publish some ideas and macro level things around startups or questions that I get asked a lot that I'm just going to record a little video and publish it there. So you can definitely follow me there. And if there are any other questions, happy to answer them.
Awesome. Yeah, I mean, Puck asks, as a non-technical founder in the AI space, he has a question about navigating partnerships. Happy to put you on, Puck. Puck, can you hear us?
Hey, thanks, Vivek, Greg, Jason, Steve, everyone. Hello, everyone. Can you hear me?
Welcome.
Yeah, we can hear you.
Okay.
Love it.
Great to be up here with you guys. So my question, as a non-technical founder for the business, I got an AI side of the business, and I've been talking to a bunch of great AI folks who have all contributed great ideas as to how to build this business model, but they don't work with each other. And so I'm having all these individual discussions with these great AI folks, but they don't work with each other. How would one navigate that ethically?
Well, are you looking to hire someone, or are you just getting mentorship advice from different people?
Well, they took the business model. I laid out the vision for the business model, and they loved it, and each of them loved it, and they were like, "This is great. We can partner with you to build it." And some of them had unique ideas to improve the business model slightly or change it, but they're all very different from one another. And so I'd like to take and meld them all together into one model, but they're different coming from different groups. And so that's where it's what's the best way to navigate something like that.
Yeah, I mean, as a non-technical founder, you're gonna get pulled in a lot of different directions. That's not unusual. And one of the key things as you're building and forming your company, I do think it's important for you to talk and interview and kind of get advice from a lot of other technical people. For non-technical founders, I do recommend finding a technical co-founder. Again, that technical co-founder may be amongst the group of people you're talking to. And there's a lot, again, probably a longer discussion than we have time for today, but that technical co-founder should be able to help you fuse a number of different good technical ideas into one ultimate product. It's not unusual for founders to get advice that pulls them into different directions. This is called mentor whiplash, where you have one smart person tell you one thing, and then you have another smart person pull you in a completely different direction. Ultimately, your job as a founder is to listen to those smart people, synthesize that, and ultimately your job is to make a decision in terms of what the direction of the company will go. And that means choosing occasionally one smart decision and ignoring another one, or in some cases fusing those things. So not too unusual. Again, without the specifics of the ideas, I don't have any opinions, but high level, I would say getting someone who you feel is on your team can be your kind of founder partner to help you steer the technical direction of your business is probably going to be helpful.
Great. I think that's a great answer. Thank you.
Absolutely.
Awesome. And one last question from Karen is, when an investor says that they're not convinced of a startup's total addressable market, how could a founder really help them? How could people convince, or are they already going down the road for a no?
Yeah, I mean, if someone's, I'm actually having a discussion with a founder this morning. They sent me kind of their idea of what they think they're doing, and again, part of me is like, okay, I like the founder, I like what they're doing, but I'm having a kind of that same, like, is the market large enough? And it's not necessarily a no for me. I would say, and certainly each investor conversation is different. I would say when they say they're not convinced, they're probably leaning no. It's probably not exactly a no. If you have a financial model, that can sometimes be helpful. And so if you articulate, well, I've done this top down and I've done it bottom up, and this is what the model looks like. Hey, I've sent you a model or a variation of the model or a simplified model as a spreadsheet, and you can play with it. But this is how I came up with my TAM models. Again, sometimes that would be helpful. Sometimes there are no anyways. And so I would, a financial, then doing that could be a valuable tool. And so, the approach would be like, hey, I have this financial model. This is how I came up with the TAM. You can play with the assumptions in the model and see what you think. I also got it from these other two things. Let me know if you want a second conversation or not. Again, don't push too much, right? Like if investors not interested, they're not interested, but they're playing the intellectual game, right? You're in that second phase of investment where they are kicking the tires on your investment and going back and forth with you. I think that's fine. Some people won't be convinced, and that's okay. Again, think through the investment process as a sales process. And so some people will be like, okay, doesn't line up with their thesis or their size of market. But it is an investment in the relationship over time. And so again, you can send the spreadsheet, ignore them for a month or two, continue to run your business. As you continue to make traction, keep them updated, listen to their feedback and build that relationship. You just never know. That person could come back to the table and be interested, or, they might opt out.
Vivek, I have one last question, Greg, if you don't mind, just to kind of squeeze it in there. In terms of AI, we obviously, when any founder is doing anything in relation to AI, they express that in their pitch deck. I want to understand the differences of what you're doing today, how you're utilizing AI, how we're training it versus what your future plans are. Would you put that would you like to see that as an investor in a pitch deck of here's where we are and here's where we want to be?
It depends on the company. Like I don't necessarily like it. For some companies, it matters more or less. My focus on AI again is what opportunities allow your company to exist or thrive today that didn't exist 6 months ago. And so it's more is today. Again, my research was really that market timing can enable certain types of companies that previously weren't possible. And so I've seen a number of examples where millions of dollars were invested 5 years ago into a certain type of company, and those certain types of companies didn't do particularly well. That same investment into the same types of companies today may do very differently because AI enables certain things that weren't possible, even 6 months ago. And so my AI focus is might be a little bit different than other investors. And so it really depends on the utilization of the technology. And so, I've seen certain businesses that are like, well, generative AI didn't allow this type of company to exist, but today it does. Or, this type of AI technology today with OpenAI allows you to do something that wasn't previously possible. And I've seen other timing things that have absolutely nothing to do with AI. And so, I had a conversation with a founder who's like, well, Congress passed this thing and it's passing in the next 3 months, and it's going to pass, and this is what it means, and this allows my company to exist where it couldn't have existed and done the thing that we're going to go do, which gives us an unfair advantage. And so it's, AI is one filter, but it's really in connection with market timing, what allows you to execute now and what gives you an advantage over companies, whether it's 6 months or a year before. In the future is more of a moat question. Like, okay, as other companies come in, what have we been able, or what will we be able to do that gives us a little bit of longer term insulation and protection?
Amazing. Well, Greg, I know we're over time a little bit, but I really want to thank you for coming on and giving back to the community and answering our questions. I will be sharing the recording with all of you as well. But yeah, this was amazing.
Yeah,
I
it's a
definitely
lot
did
of
learn.
fun. Definitely for folks, follow me on the Twitter, and maybe I'll do a spaces where we'll do pitch feedback or something like that, because this was fun for me as well.
Absolutely. Awesome. And to the newsletter, I could also I'd be happy to share your handles and all things that you want us to share as well. But yeah, thank you, Greg. Thanks,
Thank you,
everyone.
everyone. Really appreciate it.
See you soon.
Thanks.